The risk disclosures appearing on the screen are important for you to read and understand. Please pause the video now to read through the disclosures or listen in as the disclosures are read aloud at the conclusion of this video.
This is DeBartolo, a senior commodities broker with Daniels Trading in Chicago. I am the editor of the Trade Spotlight Options Advisory Service. This video is part of a series which should instill confidence in trading commodity options. This particular video will cover the logistics of an options contract. An option is a derivative, meaning it derives its price from another asset class. In commodities trading, the contract derives its price from the underlying futures contract. Options trading is a zero-sum game. For each buyer, there must be a seller. The buyer of the commodity option contract pays a cost or premium for the right, not the obligation, to be long or short the underlying futures contract from a specified price within a specified time. That premium price consists of time value, which is the value in relation to days until expiration, and intrinsic value, which is calculated from the underlying futures contract. Interest rates and volatility will also play a role in the value of the premium. Let's bring in a commodity options board. This is the December 2012 crude oil option board. The strike prices and expiration dates are set by the exchanges. Interest rates barely play into the daily fluctuation, leaving the underlying futures contract price and volatility to determine the premium. If you're bullish on the underlying futures contract, purchase calls. If you're bearish on the underlying futures contract, purchase puts. When trying to decide which strike to purchase, take into consideration the cash available in your trading account and your target in the underlying futures contract. When purchasing an option contract, the premium is deducted from the cash in your trading account, including the commission and fees. While holding the position, the long option value of your account is marked to market. This amount is not available for additional trading. Only when the position is liquidated is the amount minus any commission and fees credited to your cash balance and available for new positions. Ideally, you have the cash available in the account to purchase a strike at or near the money and before your target price in the underlying futures market. The at-the-money strike at this time is the 100 even strike price, which is valued at 4.77 points, or $4,777. The point value for options is the same as the point value for the underlying futures contract. It's $10 per point in the crude oil options market. The near-the-money strikes are generally within 5 of the 100 even strike price in either direction. Out-of-the-money strikes are further out from 5 strikes in either direction. The deep out-of-the-money strikes are commonly referred to as lottery tickets because while the cost is less, the probability of resulting in a profit is much lower. Since option trading is not a one-to-one move like its underlying counterpart, a strike's premium will fluctuate at a rate in correlation to its proximity to the underlying futures contract price. To determine this rate, look no further than delta. Delta is one of the Greeks and a calculation of change in the theoretical value based on the corresponding change of the underlying futures contract. The 100 even call currently has a delta of 51.05. For every dollar movement in the futures contract, the 100 even call will fluctuate roughly 51 cents on the dollar, all else being equal. Compare that to the 110 even call and its delta of only 23.74, which means this call option would gain just roughly 24 cents on the dollar, all else being equal. Delta, as well as the premium price, fluctuates as the underlying futures contract changes. Option contracts are decaying assets. The premium price will decrease as time elapses, otherwise known as time decay. Option contracts tend to lose value within 30 days of its expiration if the strike is not already in the money. But this will vary depending on the market volatility. Theta, another Greek, indicates how much value the option contract loses as the expiration date approaches. The 100 even call has a theta of 0.0401, or if all else remains equal, this call will lose theoretically 40 cents per day until expiration. Theta increases as the option gets closer to expiration if you are long that option. The risk for an option buyer is the cost of the premium, including the commission and fees, if the contract expires worthless. The profit potential is unlimited, but keep in mind option contracts are decaying assets. The increase of the volatility or unpredictability of an option typically results in higher premium prices, while a decrease in the volatility typically results in lower premium prices. Ideally, purchase an option contract while volatility is low and liquidate that option while volatility is high. If you are selling or writing an option, an opportune time is when volatility is high. In the next video in this series, I will discuss selling or writing commodity option contracts. Until then, happy trading.
When investing in the purchasing of options, you may lose all of the money you invested. When selling options, you may lose more than the funds you invested. A person contemplating purchasing a deep out-of-the-money option, that is, an option with a strike price significantly above, in the case of a call, or significantly below, in the case of a put, the current price of the underlying futures contract or underlying physical commodity, should be aware that the chance of such an option becoming profitable is ordinarily remote. The risk of loss in trading futures contracts or commodity options can be substantial. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure webpage accessed at www.danielstrading.com at the bottom of the homepage. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or other similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services.